to talk about all of that, the markets and the economy right now, with Veronica Clark. She's an economist at Citi. Also, Jack Caffrey, who's equity portfolio manager at JP Morgan Asset Management. Jackson Hole is front and center. And Jack, I know you just came back from there, but now it's the Fed's turn and all of the speakers there to try and figure out what they're going to do at Jackson Hole. Veronica, what are you thinking? The question we've been talking about this morning is how quickly do they try and get to 2%, or should they?
Yeah. I mean, I think Powell's job on Friday when we hear him at 10 a.m. Is really to just not rock the boat at all. I think the Fed's probably pretty happy that we've had this move higher in long end yields that is tightening financial conditions, but they haven't had to be substantially more hawkish on the policy rate. I think the goal is to not rock the boat here.
Not rock the boat. Is that going to be easy to do, though, when the entire world is trying to parse every word?
Yeah, no, I know. I mean, we've had a lot of questions on Jackson Hole. There is this expectation that they're going to be talking about the neutral rate. Maybe neutral rates are a bit higher. I think that's probably pretty baked in that he'll say something along those lines. But I wouldn't really expect, a conclusion that, yes, absolutely neutral rates are higher. That means we need to leave rates, even higher levels. But this idea that higher for longer, I think that probably sticks around.
Higher for longer and the higher yields we've seen recently, Jack, what's that mean for equities?
Well, it's certainly been putting a lot of pressure on the valuation side of issues, particularly for those more secular growth stocks, which in some senses we spent a decade and a half of thinking, $1 of earnings 5 years from now or 10 years from now were really no different than $1 today, given that lack of inflation and given that lack of alternative opportunity. Now you actually can get something on cash. And now I think you are starting to wonder, to what extent do we have more interest rate variability, giving us more economic variability, giving us more ultimate earnings variability. And so the future is a little bit less valuable.
What are you telling people to do right now differently than you would have a year ago?
Relative than a year ago, I think it's a little bit harder to play the tails of the broader market. Guessing the economy is hard, and that's why I try not to do it. Deep cyclicals actually need an ability to talk about 3, 4, 5% growth, similar to what we had coming immediately out of COVID. I don't know that we necessarily go back to that terrific twos of 2% real growth, 2% inflation that lasted for a decade and a half post-GFC. I think instead you want to be paying attention to earnings you can count on. I like dividends in particular. I like that cash flow. And I think trying to be a little bit more core-like rather than emphasizing the tails that are running, if you will, a barbell makes a little bit more sense today.
Do you consider like the Fab Five of technology, the 7 big guys that are out there, or the 5 that are above $1 trillion in market cap right now? Do you consider that kind of core? Or is that something where the valuations are getting a little richer? We're going to hear from NVIDIA tonight. It's one of the 5 that's valued at more than $1 trillion.
Well, I think to some extent you can say, what do you think of the market, or what do you think of the Fab Five or the Magnificent Seven? And those two questions are unfortunately one and the same right now. Certainly year to date, it's been really a story of AI. AI has been driving NVIDIA. AI has been driving Microsoft. AI has been driving the Amazon story. So, 3 of the Fab Five wind up right there, and to a lesser extent, Alphabet. The one that hasn't really been driven so much has really been Apple, which kind of comes back to Apple's becoming a services company.
Which means what? You would take them at the same valuation?
I don't think you can take them at the same valuation. And I do think what's interesting is as we think about this move to AI, you're seeing what were historically very asset-light businesses are becoming asset-heavier. And they actually start thinking about things like depreciation and depreciation schedules from businesses that might have originally had 90%, 95% gross margins.
So does that make their earnings less valuable over time?
It doesn't make their earnings less valuable. It means that you wind up in a situation where they actually have constant cash needs and that they don't throw off as much investor or owner earnings, if you will.
So not as much in terms of either buybacks or not in terms of...
In the short term, it feels like you're going to have some...
Dividends for those that pay them?
Well, I come back to I really like dividends because I like the consistency of that commitment that a dividend seems to promise. Buyback activity, wonderful when it happens, but to some extent it winds up being very pro-cyclical. And so it winds up making the highs higher. And unfortunately, when they fall out of the market, we feel it, whether it's in the run up to earnings or when management teams are just very cautious on what might be happening.
Veronica, can you answer Jack's question about whether we get back to 2% growth, 2% inflation?
I know.
What do you see happening?
I mean, that is ideal, but I do unfortunately think there's a lot of reasons to think that we're not getting back to 2% inflation too soon. You probably would need, a broader contraction to get there, something that we would probably call a recession.
Well, that's good news then. If we're
and we can still have that. That's actually still our base case for the first half of next year. But even looking longer than that, there are a lot of reasons to think that maybe inflation is just higher now. Things like the green energy transition or this, reshoring, onshoring of goods production. We're seeing some of that start to happen in some of this data, and that just means that inflation could just be higher for longer.
Should we be okay with that?
I mean, that is the big question. Is the Fed really going to get back to 2% exactly? Are they going to be okay with 2.5%? Probably. Are they okay with 3%? Maybe. 3 to 4%? Probably not. And that's where we look like we are right now. Underlying inflation kind of looks like in that 3 to 4% range, and that is still probably too high. It's all just numbers.
Yeah. Like age, right?
3's good.
The one thing you would be listening for from Jay Powell on Friday, I know you're thinking he's going to try and not say anything, but what are you going to be like?
Yeah. I mean, I don't think this is going to be as many fireworks as we had last Jackson Hole. But yeah, I mean, I'm looking for some discussion of potentially that neutral rates are a bit higher, at least in the short term. We've all been surprised at how resilient activity has been. That does kind of maybe tell you that neutral rates are a bit higher. We're not as restrictive at this level of rates as we thought. And I think investors are looking for that kind of discussion too. So if it doesn't happen, maybe that's the bigger surprise. But yeah, just some idea that we still have more work to do on inflation. Rates are at a restrictive level, hopefully, and they're just going to be there for a while as inflation comes down.